dynamics in times of COVID. We're very glad and excited to have Michael, Nick, and Laura with us today. We're going to have a session talking about productivity and firms during COVID from different perspectives. So hopefully we'll have an interesting discussion. And we'll have Laura Alfaro chairing the session. So we're very excited about that. So Laura, I'll give it up to you. And thanks everyone for joining, and Laura and Nick and Blue and Michael for joining the session and agreeing to participate today.
Thanks. Let's start with Nick, the impact of COVID on US firms.
Okay, thanks, Laura. So let's see if I can get my screen sharing to work. I have a weird setup on here you go. Everyone can see themselves right now. Okay, so I went for something a bit broader. So I'm going to talk about productivity growth just because it's become so topical. So why don't I say, what do we know historically before the pandemic? Well, US productivity growth has been slowing since the 60s. Here's labor productivity growth per quarter. It was about 4% at the, just after World War II in 1950. It's fallen all the way down to about 1%. Turns out that's pretty common. And this is Chile here, but across, this is a slide I've just taken from Chad Syverson. If you look across OECD countries, it's slowing down. Right before the pandemic, I was actually out in Singapore doing some policy stuff there, and Singapore's not on this graph, had the same issue. So globally, productivity growth has been slowing down. If you look at longer run data, it's kind of interesting. So to get really long run data, we have to go to the UK, at least it's one good source of it. So this is UK productivity growth data going back annually for 300 years to the beginning of the Industrial Revolution. And then I put one dotted line where you can use, growth data back to 1000 AD. You just look at GDP per capita of various estimates. Basically, what you see is productivity growth was almost zero. So incomes per capita roughly doubled between 1000 AD and about 1750, which is about 0.1% per year. And then productivity growth from the beginning of the Industrial Revolution has been picking up and up and up. This is the kind of idea of standing on the shoulders of giants. People come up with steam, it makes you more productive. They invent better paper, they invent railroads, they invent electricity. It kind of peaked around World War II, the 1950s, then it's been on the decline. So I just showed you a lot of this data for the US. It's consistent with the UK. You just see there's basically two changes, Industrial Revolution and then the 50s. And I'm going to argue that these changes don't happen very often. So I don't think COVID is going to radically change this trend. So, I'm not going to spend time on it. One argument, I have a paper out a couple of years ago arguing it's just simply harder to come up with new ideas. So, just from being at Stanford, with, Mike and Laura, for example, at Chicago and Harvard as well, I'm sure you said the same things. It's postdocs take longer, labs are more expensive, it's more interdisciplinary, it makes things more complicated, et cetera, et cetera. So what about, where are we now? What's the impact of COVID? So this is what I was going to talk about. I'm just going to shrink it a bit to make it a bit broader. So I have a project with folks at the Bank of England and Nottingham University to collect data. We have a big survey team. They're collecting data from about 3,000 firms a month, and it covers about 10% of UK employment. So it's a big survey procedure. I'm not going to spend long on it, but basically once a month, they get sent about a 10-minute online survey, asks a lot of information about sales, employment, both current levels, and some nice survey questions like what's the effect of COVID on your sales? What's been the effect of COVID on your employment, on your input costs, et cetera, et cetera. So this is the paper. We try and estimate the direct effect of COVID on productivity. And what do we find? So this is, on the left is labor productivity per hour, and on the right is TFP. So why don't I start with the left? It's a bit easier. So labor productivity per hour, oddly enough, maybe it's surprising, actually had a very positive impact in our panel of UK firms. You actually see that in national accounts, you see it in US national accounts. So if you look at US GDP, it's significantly up, it's about 3% up versus pre-pandemic, and hours are down. So labor productivity, value added per hour is well up. What's going on? Well, we see the same thing in our firms. The reason is there are two offsetting effects. The big blue positive is a between firm effect, and that comes from two sources. One is about half of it between industries. So what's happened is low labor productivity industries, think like leisure, travel, entertainment, have shrunk. These tend to be low wage, low labor productivity industries, and they've shrunk. and things like manufacturing, financial services, technology have actually done relatively well. So that is just a pure compositional effect between industries. The other half of this blue thing is between firms within industry. It turns out bigger, higher productivity firms have done relatively better. So bigger firms have coped better with the pandemic than smaller ones. They tend to have higher labor productivity. That accounts for all of the blue bar. So there's been a very big between firm effect that's positive. The within firm effect is negative. So like for like firms are reporting that costs have gone up and that's reduced value added. And so that's this negative part. You can notice early on in the pandemic when there was a massive contraction in output and a lot of reallocation, it's positive. In the long run, we don't predict much of a long run labor productivity effect. So much of the between effect is going to revert when sectors resume to kind of normal sizes and firms resume to normal sizes. So what about TFP on the right? TFP is very similar, except the only thing worth remembering is labor productivity is value added per hour worked. TFP is basically value added per hour worked to the 2/3 times capital to the 1/3. And the capital stock has hardly changed. So inputs drop less when you look at TFP than they drop for labor productivity. So effectively everything's kind of shifted down. So TFP just looks less positive, more negative, but again, in the long run, it's close to zero. So at least as far as firms forecast, I mean, these are like 3,000 firms per month. They kind of net match this, by the way, match aggregate data. So for the UK, this is exactly what we see, and the US actually, labor productivity is positive, TFP is slightly negative. We see that in both the UK and the US. So I think this kind of aggregates up. Here's the underlying drivers. Firms tell us basically costs have gone up, and it's because it's harder to use capacity. Think of restaurants, you can only use half your tables. There's a lot of time spent washing hands, social distancing, etc. Prices are relatively flat, as we know. Capital stock hasn't changed much. It's very hard to change the capital stock. Everything else is basically down. Employment, sales, hours are way down. So you can see labor productivity is up because hours worked fell more than sales. All of these in the long run are probably revert back to something close to zero. So the pandemic eventually is probably not going to lead to major direct effects on productivity. It's been pretty major in the short run. In the long run, we don't estimate anything first order. One thing I kind of worry about is this, which is when you survey CEOs and managers, you ask them, how much time are you spending managing COVID? For both, Laura, Mike, and I all teach MBAs and execs. This is a lot of time to spend managing COVID. So the average manager is spending about 10 hours in our survey on managing the effect of the pandemic. If you think they're probably working 60 hours a week, that's a huge amount of their time. And it's almost certainly coming out of other activities that would have otherwise produced long-run productivity improvements, reorganizations, new products, new processes. So, you could be negative and say, look, you've sucked up a lot of senior management time into dealing with the pandemic. It's disruptive. That will be a downside. So what about looking ahead to the future, productivity yet to come? So one angle, I know Mike's going to talk more about this, is working from home. So working from home has increased a lot. We're just having a discussion at the beginning across central banks. So just to give you some numbers, this is for the US. Before the pandemic, the percentage of full paid days work from home was about 5%. So you have this number from the American Time Use Survey, it's pretty accurate. So, some people did work 4 days at home, but it's kind of rare. During the pandemic, it's about 50%. Where does that come from? Well, half of Americans cannot work from home. So these are frontline retail, manufacturing, schools, hospitals. Most of those employees cannot work from home. So they have not been working from home during the pandemic. They either weren't working or gone onto their business premises. The other half, probably everyone listening, like managers, professionals, graduates, have been and they've been doing it full time. So that's where you got to 50%. Half of people are doing it full time, half not at all, roughly speaking. If we look ahead, what's going to happen post-pandemic? Well, as we were discussing, Federico was mentioning earlier, I mean, we collect a lot of data from firms and from individuals. They all point to the same thing, that hybrid, whereby you'll say in the office 3 days a week, at home 2 days a week, or 2 and 3, is becoming standard. So we now have an economy where half of people are remaining coming onto the business premises every day. Nothing's changed for them. The other half of people, folks like us, have gone from full-time working from home during the pandemic to post-pandemic, typically going to work from home 2-3 days a week. And that's where you get this 25% number. So that's a pretty major change. The number of days work from home has gone up 5-fold. Will that increase productivity? I know Mike has a different view on this. I've run one randomized control trial, running a second one right now, and collected a lot of survey data. There's a large, I'd say a pretty large literature from this. Mike has different numbers. Our survey data and the papers I've seen typically find working from home increases productivity, but not massively. So the numbers we estimate are 3 to 5%. Where does that come from? That really comes from two sources. Most of it is just on saved commuting. So the average American commutes about an hour a day. If you work from home 2 days a week, you save 2 hours a week. In the data, in the survey data, we see that people, when they save time from working from home, spend about half of it working on their primary job. So the average American post-pandemic, or at least half of us that are working from home hybrid, probably are going to put in about an hour more of work a week. You could say that isn't labor productivity. You could say that's just an increase in hours, depends how you measure it. But normally the BLS and statistical agencies like that wouldn't measure that increase in time as hours. So that's one source. The other source is it's quieter at home. And in the randomized control trial, that accounted for about 4% increase in productivity per minute. So there were like fantastic stories of how noisy the office was. I remember someone told us, like, the person in the desk next to them used to clip their toenails under the table and said it was horrible. The offices are pretty noisy. So for hybrid, those 2 days a week are supposed to be, think of an economist, we're doing data work, we're doing reading, writing, stuff that's actually better done at home. So this is where this productivity effect comes from. It's something, but it's definitely not going to permanently change the course of future productivity growth. A second thing is working from home could also improve itself. So this is directed technical change. So this is a paper with Yulia Zeskova and Steve Davis. We scraped the patents coming out of the US Patent and Trademark Office for the frequency of the words telework, remote work, work from home. 0.5% of patents mentioned that before the pandemic. Now it's shooting up. So a second thing is, this is kind of Schmookler in action, that if the market size for working from home technology has gone up 5x, a bunch of firms are putting a huge amount of resources into making this better. So, much as Zoom and the cloud have really helped working from home now, and their innovations come around in the last 5 to 10 years, be a lot of other stuff. So that could maybe increase productivity. I doubt it's going to be that big. A third thing I think, which is negative, is the costs and the problems with density. So we asked this question: which of the following would best fit your views on the return to activity post-pandemic? And 28% of people on average say they completely go back. In fact, this is US data. I've seen similar data for the UK, and we've recently done something with the EBRD, right, pan-European. It looks very, very similar. So the survey data says around a quarter to a third of people claim they completely go back, but most people claim that at least avoid the subway, crowded elevators, etc. I don't know even where I'd feel. Would I feel comfortable getting into an absolutely packed tube train or subway, or getting in a crushed lift or elevator? It's not clear. This raises productivity issues as to whether these kind of activities will fully return post-pandemic, and if they don't, tall buildings have some capacity issues. So skyscrapers require people being packed to go up in the mornings and packed coming down in the evening. So this may be a negative long-run effect on productivity. So right on time. In summary, I don't see any major long-run changes to productivity growth. It's been 2%. It's been about 1% for the decade or so before the pandemic. The pandemic's had some pluses and minuses. Net, I honestly don't see them changing that much. So labor productivity is probably going to remain to about 1%. TFP probably about 0.5% for Northern Europe, the US going forwards. I could be wrong. There could be amazing robots, AI, virtual reality, whatever you want. Could be, but just looking back at the data, there's only twice been major changes in productivity growth trends since 1750. So, and I doubt we're going to see odds are, in my mind at least, odds are against seeing a third. So more of the same would be my prediction. I'll stop.
Thank you very much. This is great. It also probably suggests that the idea of open space offices was never a great one. I'm grateful for my door. The next one is Mike, work from home and productivity, evidence from personnel analytics data on IT professionals.
Sorry, I had to unmute. Thank you, Laura. Nick, that was great listening to your talk. I'm glad I got a chance to do that. What I'm going to present is, it's a little bit different. I have detailed data on one company. I'm going to do sort of a deep dive in it. This is joint work with Friedrich Mengel and Christoph Siemroff, who are at the University of Essex. We were working with a company, a large IT services company in Asia, to launch a field experiment in March of 2020. Obviously that didn't happen, but because we had that working relationship, we were able to collect some interesting data. And so what I'm going to discuss is what we found. What we're doing is comparing employees' performance and their work activities before and during the period that the company was in lockdown. What happened is in March 2020, they shifted abruptly to 98% working from home. 2 weeks before that, they had essentially not been working from home. So we have a dramatic change. It's a little bit like a pathological study in medical school. And what I think, the way I see this study is it's a case study. It doesn't tell us much about what are patterns of productivity in various firms, but what it's going to tell us, since it's such an extreme event, is it's going to give us some insights into where working from home is going to be more difficult or more easy. And I think that's informative when we think about going to hybrid models and so forth and so on. Okay. So as I said, it's a large Asian IT services company. They're a global company, but most of their employees work in the native country. The sample we're using is their R&D professionals. So these are highly skilled bachelor's or advanced degrees in engineering and electronics and so forth. They're working closely with colleagues and with their clients. So their jobs involve a lot of innovation, a lot of collaboration, a lot of client engagement, and significant cognitive work. And the reason I mention that is that's different than the other studies of working from home, such as Nick's famous study in the QJE looking at call center workers. I think the job design being different is interesting. We have data on employee characteristics. We know how long they've worked in the industry, how long they worked at the firm, their age, their gender. Because almost all employees get their health insurance through the company, we were able to get data on whether they have children at home or not. And we have a measure of their commute time because the company knows their home address, was able to estimate that for us. The company has various applications that they use to monitor and track employee work and performance, and we got access to several of those. One is data from an app called provided for them by a company called Sapiens, and the other is data from Microsoft Workplace Analytics, which is another tool they use. So we're able to use those to get some insights into how they're spending their time, how many hours per day they're working, the extent of time in which they're able to focus. I'll talk about something called focus time in a few minutes, the extent to which they're collaborating with others, spending time in meetings, or doing networking with others through emails or chats and so forth. Okay, so one thing we have is the total hours they're working per day. And I'll call that input informally. And then we have a measure of performance as well. We have the primary performance measure that the company uses to track performance for each employee. We also have the subjective valuation, but I wouldn't talk about that here. But every employee is given a primary measure and a performance measure reflecting the major activity in their work. Their supervisor tracks it. It's measured every month as percent of goal, semi-annual goal. And the reason that's nice is we have a measure, though, that is measured in a comparable way for all the employees. Even though we have different measures, we're all being measured as percent of achievement of goal. So we call that an output measure, and then productivity naturally would be how much are people performing in their performance measure, given the amount of hours they're worked. Now, notice that definition of productivity is not the same as Nick's definition. He's done some work with my colleague, Steve Davis, and they have a broader definition, and I think rightly so, about productivity. They're including things like saving work time, commute time, and so forth. So one thing we have to keep in mind is when I say productivity in this presentation, it means something a little bit different. Okay. All right, so this picture tells the basic story on productivity. In the upper left, all of these pictures have time on the horizontal axis. In these pictures, we have months. We collected data on the employees for months before the company went into work from home, and then for 5 months after they went into work from home. So date 0 is March 2020, when work from home, the shift happened. And in the upper left, we have hours worked per day. as measured by these two apps. We have two different measures and they're pretty comparable. And what we see is a very dramatic jump in hours per work, about 2 more hours per day when they shifted into work from home. It happened almost immediately and it persisted afterwards. In the bottom left picture, we have the performance measure that I alluded to, what I called output, percentage performance against my goal for the month. And what we see is it's more or less flat over time, but there's a small decline in employee performance on average in the work from home period, which is sometimes statistically significant depending on what you control for. And you can see that in columns 3 and 4 in the regression table. And then finally, putting those two things together, the ratio of those is what we call productivity. What is your performance per hours worked? That's going to be noisier because it's a ratio of two noisy variables. But we see, again, a dramatic decline in that measure of productivity when there was a switch to work from home, and it's persistent. And we have several ways we can measure that, but what we estimate is performance per hour for these employees on average fell from something like 10 to 20%. Okay, so people are working more hours. And we can see another measure of that in the upper left here. This is weekly data in these plots here. And you see that jump in hours again. How are they spending these extra hours? The first thing we can say in the upper right is they're working longer days. They start earlier and they work later. And this will come as no surprise. In fact, it almost has to be definitionally true. If I'm working more hours, I'm going to be working more outside of the normal 9 to 5 hours, but we definitely find that. And that wouldn't be surprising for all of us working at home. We can work at 11 p.m. if we want to, or 4 in the morning if we get up early. Another measure we have is called focus hours. And this is a measure from the Microsoft Analytics data of time that the employee has spent working when he or she isn't being interrupted by meetings or emails or chats or communications with others. So presumably can sit and focus on their work. And what we see is there's a significant decline in total focus time. And that's interesting because we're working more hours per day, but with less focus time in that same day. And part of what's going on is we're spending more time in various communications. One measure of that is collaboration hours, which is the bottom right picture. This is a measure of time spent in various kinds of online meetings. This company uses Microsoft Teams, which is a Zoom competitor, but basically has the same functionality. And you can see a small rise here in collaboration hours, which is actually statistically significant, although maybe not economically significant. But now look at this picture. On the left, we see the number of emails that they're sending, and that really isn't changing very much. But on the right is the picture that I call Zoom doom. This is the story of our life during COVID. None of us had ever heard of Zoom, or most of us had never heard of Zoom until COVID hit. And then all of a sudden, our Outlook calendar was filled with all these Zoom meetings. And that's exactly what's happening at this company. People are spending more time in meetings, but dramatically many more meetings. So there are a lot more meetings I have to attend. They're shorter meetings. The other thing I can say is these meetings are larger meetings. They're large groups of people. So Nick had some data on executives spending more time dealing with COVID. And I think that probably reflects a similar thing. Managers and supervisors spending a lot more time coordinating large groups of people and trying to manage them. At the same time, a couple of other things declined. If I'm working at this company, my social network is shrinking. This is my sphere of the people I interact with. I'm sending more, I'm communicating less by email and phone and chat with individuals inside the firm and outside the firm, such as clients. And I'm also contacting fewer organizational units inside and outside the firm. For whatever reason, people are narrowing their communication spheres. And even though I'm doing more meetings, those tend to be large group meetings. I'm spending fewer meetings one-on-one with my supervisor, fewer small group meetings with my manager and my close colleagues, and fewer coaching meetings at the same time. Okay, so as I said, average productivity is falling. I have limited time here, but I'll try to say a couple of quick things about it. First, in this picture, we have regressions predicting the effect of working from home for the same person. We have data working from the office and then after working from home. So we're going to estimate the working from home effect. And as you can see, hours worked increased dramatically. That's the first row in first regression. output fell and therefore productivity fell. But what are the causes of that? First thing we find is that those who worked at the company longer had a smaller decrease in performance. So those who are more experienced, have more firm-specific human capital, probably have better working relationships with colleagues, were able to adapt to working from home better than those who'd been there less. And then the second thing, going down to that second highlighted bar, is that those with higher career experience, presumably more senior managers in the company, spent dramatically more time working, although it didn't improve their performance or their productivity. And that's consistent with this idea I alluded to in a previous slide and something that Nick had said. Okay. Briefly, we also have data on commute time. And what we found is commute time is positively correlated with the amount of time spent working, but it's not significant. So these changes in productivity don't seem to be related very much, and certainly not statistically, to the fact that these employees have saved commute time. And this is a country where commute time tends to be pretty high. These are developing countries. I'm going to pause for a second because I see there's a chat window. I wanted to make sure no one's asking questions. Okay. All right. A couple of other brief things that I'll mention. We had data on gender. We had data on whether there are children at home. First thing we find is that women had a larger decline in productivity than men. And that is true whether or not they had children at home. The second thing is both men and women with children at home had a larger decline in productivity than those who didn't have children at home. But that children at home effect is uncorrelated with gender. So it's pretty much the same effect for men as for women. So children at home do appear to distract and reduce productivity, not surprising at all. Similarly for men and women, but women are having a larger decline in productivity. We're not sure how to interpret that. One thing to keep in mind is this is a country in which many people live in large extended families. There may be in-laws or grandparents living at home, and our guess is that women have more of the duties, the domestic duties with the broader family. And then the last thing, I'm sorry, 2 minutes?
2 minutes, yeah.
Thank you. The productivity decline we found varied across teams, but it was true for almost all teams. This seems to be a broad and persistent effect. We tried to analyze whether this was related to pandemic policies, variation, severity of the pandemic in the country, the number of sick days of employees, and so forth. And we found no evidence that that was the case. So again, this seems to be a real productivity effect. What are the things that we found are most significantly correlated with productivity, both in working from home and working in the office? The first is focus time, being able to sit and not be interrupted by all of your devices. The second is the extent of your network contacts, your social network, the more people you can contact inside and outside the firm. And the third, negatively, is time spent in meetings. Okay, so as I said, this is a pathological study, but our main conclusion is that jobs involving a lot of interpersonal interactions and communication, collaboration, innovation, and coordination are the type which are likely to have the most difficulty with large-scale working from home. And these are the challenges that companies will need to face when they're moving into a hybrid model. And I also want to mention that there's another thing that we couldn't measure here, but it does concern me, and that's the loss of intangibles, such as innovation and training and corporate culture and so forth. I guess that's about my time. Thank you.
Thank you very much. The next paper is Federico, Anatomy of Firms' Margins of Adjustment, Evidence from the COVID pandemic in Chile.
Great, thanks, Laura. This is joint work with Elias Albagli, Andres Fernandez, and Juan Garrasalas from the research department at the Central Bank. So the motivation for this project is that, COVID has been a large shock that has caused substantial reallocation of resources. That's sort of a common theme across countries. In Chile, there has been a sharp contraction followed by a V-shaped recovery. There have been significant monetary, fiscal, and credit policies, and there has been a significant distributional impact of the crisis. I guess these are also features that we can see in other countries. So we want to ask, what's the role of firm behavior in these dynamics? The literature so far has offered sort of partial evidence of this coming from different places. So there's usually study of either a subset of firms, kind of case studies, or sort of more broader studies, but with more limited information, or looking at just subset of margins of adjustments. This paper will try to look at which are the micro patterns from firm behavior that build up into the macro patterns that we see in Chile. So we'll study simultaneously nearly all margins of adjustments of firms that are usually studied in the literature, but sort of looking at them all together in the same place. And we're leveraged on this massive admin data repository that we've been building at the central banks, the Central Bank of Chile, to do statistics, policy, and research. So more in detail, we'll trace the real effects of the pandemic shock and the effects on some policies. We'll do this for firms in Chile for which we have this unique admin data. And we'll cover some stylist facts on these different margins. So the output market, the labor market, intermediate input market, physical capital market, and credit market. And we'll connect this at the end with the patterns that we see of aggregate productivity, looking at a bunch of features of heterogeneity across size, sector, and so on. So we'll talk briefly about the data, the margins of adjustments, some of the policies, and productivity. In terms of the data, this is a pretty massive effort that the Central Bank of Chile is doing in terms of putting together all the admin data that the state of Chile has in one place to do policy, research, statistics. So we'll use sort of a standard firm production data set coming from taxes, a firm-to-firm intermediate input transaction data set, which is very high quality. These are electronically submitted transactions to the IRS for every transaction between firms in the economy with prices, quantities, and so on. We'll use a credit registry that has firm-to-bank transaction, the employee-employee data, which is sort of standard at this point in these type of studies, and also credit and employment policy data set at the firm level. So we'll know exactly when a firm adopted a policy for all these two policies that we'll look at, which is the employment protection law and the public credit guarantee credits. So in terms of the output market, we can see that there was a fall in the number of firms reporting positive sales, sort of a sharp decline of around 14% between February and June. But what's interesting is that 2 out of every 3 firms that exited actually re-entered afterwards. And so the median length of firm exit was around 5 months between March and May. But there's a lot of heterogeneity across sectors and size, and almost all of this re-entry is coming from small firms. And in terms of sectors, manufacturing and commerce have been important. If you look at more on total sales, you can see that the sales sort of declined a lot at the beginning, but then the recovery in Chile at least was sort of that at the end of 2020, sales were recovered. But there's a lot of heterogeneity. So around 50% of firms saw their sales decline, but around 47% saw their sales actually increase over sort of the first months of the pandemic. Again, there's a lot of heterogeneity. If you look at sectors on the right-hand side, you can see that restaurant and hotels were pretty affected and they didn't recover very well, whereas manufacturing and commerce were hit at the beginning, but they recovered very fast, and actually they're doing much better now than before. If you look at employment, you can see that sales actually fell as employment similarly in the first months, but the recovery has been very different. So employment has been sort of lagging behind, sort of suggesting what Nick was showing before, that labor productivity is going up. Again, a lot of heterogeneity in terms of declines and increases on employment, and also a lot of heterogeneity across size, at least. You can see that, in terms of the decline and also the recovery, it has been sort of ordered by firm size in a pretty sort of clean way, as you can see in this right-hand side graph. If you look at intermediate input markets, so we can measure sort of number of links with suppliers. You can see that, there was an increase in destruction and a decline in creation in the first months of the pandemic, but then sort of the net creation sort of recovered sort of at the end of 2020. But what's interesting is that if you look at the number of sort of recall rates, if you want, sort of the share of links that were destroyed that were afterwards rebuilt with the same link, so sort of conditional on a, say, if you look at April, there was 40% of links destroyed that month. If you look at the months afterwards, there was a 40% probability of recreating the link with these sort of same relationships that were destroyed in April. So a pretty strong recovery with the same linkages. And that was sort of one of the reasons that we think also that the recovery has been sort of strong in Chile. If you look at investment, you can see that, you know, investment had a sort of a faster decline at the beginning, but the recovery has also been faster relative to sales, at least. And now we see actually, you know, investment around 20% above the levels we had before the pandemic. It has been super robust across sectors and size, except for restaurant and hotels, where you can see that the investment is sort of lagging behind. In terms of the credit market, this has been very interesting in Chile. So usually in the left-hand side graph, you can see that credit has been pro-cyclical, sorry, in past crises, whereas in this crisis, it has been counter-cyclical. And big part of it is coming because of the policies that were implemented. But what's so sort of interesting is that the credit flowed non-linearly, in the sense that it went to firms that were sort of doing well, and also firms that were doing not so well. So there was sort of a non-linear relationship between performance and credit allocation. But sort of the main message here is that the leverage, sort of debt to sales, has been going up massively. And obviously this is one concern. That the policy that I'll discuss in a minute has been sort of effective in allocating credit towards firms, but then potentially at the cost of sort of increasing leverage and maybe creating debt overhangs a problem in the future. So let me talk now a bit about the policies. There was this big policy, that was this public credit guarantee that was implemented at the beginning of the crisis. This policy already existed before the pandemic, but it was sort of amplified and expanded massively, and the conditions were so sort of much more favorable during this crisis. So, you know, by the end of 2020, we have around 40% of firms already obtaining at least a little bit of money from these loans. And the idea, you know, is that the loan has this logic. For the ones that are not familiarized with this, is that, you know, that the state is going to absorb the risk if you don't pay back. And that's going to sort of increase the likelihood of banks sort of allocating money to risky firms or firms that are not doing very well. In terms of the amount, in the bottom right graph, you can see that the amount of this policy that was called FOGAPE was sort of mostly allocated at the beginning of the pandemic. And then the bottom left graph sort of reinforces what I was saying before. The credit growth was sort of stronger going to firms that were doing bad, that were sort of having declines in sales, and also firms that were having increases in sales. And so sort of this is telling you that, again, the credit was sort of flowing to sort of the extremes of the distribution of performance that firms were having. One of the features of this policy is that, you know, the interest rate was very low, was sort of capped very low. So in some sense, for many firms, even though, I mean, mostly the ones that were doing well, also this was almost free money. So there was some sort of like arbitrage opportunity in terms of taking this money, investing it, and then having something in return. So maybe that's why firms that were doing well also took up this money sort of significantly. We did some macro event study. This is super basic, but it's also already sort of telling us something interesting. We can look at the total sales of firms that took the policy. This is the red line, and firms that didn't take the policy. This is the blue, the blue line is without the policy, and the red line is with the policy. So you can see that firms that took up this public credit guarantees, they did worse at the beginning. This is sort of suggesting that there was some selection, you know, in terms of on average, maybe the firms that were taking this policy were not doing very well at the beginning, but then they recovered relatively more than firms that didn't took the policy. Again, this is just aggregate numbers, but it's sort of already suggesting something about selection into this policy, but also in terms of recovery by using this policy. You can see a similar figure with investment. The investment of firms that took the policy was sort of had a sharper contraction, but a stronger recovery afterwards. Obviously, this is just sort of correlation at this point, and we're sort of currently working on more sophisticated micro event studies to kind of disentangle other confounding factors that could be driving some of these results. But I think these are already very interesting. Let me finish by saying a couple of things about productivity. So what we do is that we estimate productivity in sort of the usual sort of production function estimation approach from the IO literature. So you can see in the top right graph, the blue bar is the growth of productivity. So we see a growth of TFP going on for a little bit more than 4%. This is coming mainly because, you know, the value added went down. This is the red bar, but employment went down even more. This is the blue bar, and the orange bar is capital. So you can see that, you know, things were going down, but employment was going down relatively more than value added. And this is sort of consistent with what I was showing at the beginning in terms of employment lagging the behavior of sales. But again, a lot of heterogeneity. If you look at the bottom right graph, sorry that this is in Spanish, but the bottom right graph is sort of separating firms in terms of the firms that had a decline in productivity and the firms that had an increase in productivity. And the group in the middle are firms that didn't change productivity that much. And you can see that around 38% of firms actually saw their productivity increase, whereas 56% of firms saw their productivity decline. And the firms that saw this productivity decline actually did not very bad in terms of employment, but it's just that, you know, value added was contracted significantly. If you look at the left-hand side graph, we split this across a size of firms. So the left-hand side group is small firms and small firms. The group at the middle is medium firms, and the group at the right is large firms. And you can see that, you know, firms in the middle of the distribution and large firms saw the productivity increase, and these are sort of pushing the averages that I was showing you in the upper right-hand side graph. But the small firms actually saw the productivity going down because, you know, value added is going down more than employment for these firms.
2 minutes.
So you can see again, thanks. You can see again, you know, there's a lot of heterogeneity across size and also heterogeneity just in terms of the magnitude of the changes in productivity that we see in the data. We're currently at the stage in which we want to sort of connect these findings of you know, standard TFP measures with the moments that I was showing you before, in terms of looking at the correlation of sort of which firms were increasing more productivity and how that maps into these different margins of adjustment that I was showing you. And one thing that we've been finding that it's very interesting is that the firms that increased more productivity were the ones that were able to manage better their links with suppliers. So the ones that were actually able to increase the number of links with suppliers were the ones that were able to kind of also increase their productivity. Obviously, there's no causality here. This is just a correlation, but these are the types of moments we are looking at. So I'll leave this here. This is sort of a summary of what I said. Let me just tell you in a couple of seconds that we're working on studying also the employment protection law, which was this other sort of labor furlough policy that was implemented at the same time as this public credit guarantee policy, and is sort of complementary but had different incentives and also different effects. And then the last thing is that also the advantage of the data that we have is that we have really micro data on prices, and we can sort of track how prices have been increasing and where this is coming from, and how sort of disruption in different parts of the production process has led to this increase in prices that has been translating into a very high inflation in Chile, at least. But thanks a lot.
Thank you very much. I do have to say that looking at these three papers that complement each other very nicely, one concern is that it does not seem that productivity gains will be even medium-term sustainable, and that does say something about the sustainability of all the policies that were implemented. Many countries did increase a lot fiscal deficits, and again, if we don't manage to create long-term productivity, it's hard to see long-term growth to make these policies sustainable. One suggestion to Federico would be, again, just to complement some of the results that Michael advanced, would be to see the gender composition of your employment and unemployment. There is also this implication that generational younger workers are complaining that they're not getting their training because people don't come to work, and that may also affect productivity. But as we know, this crisis has had a woman face. And again, some of Michael's results do suggest that productivity-wise has also been complicated. Women may like and may say that they want to work from home, again, looking at some of the other results, but then they are overburdened by many things. The other thing that I don't see how it's going to be sustainable is if we ask schools to return full-time, but everyone else is at home. But that is something else in terms of who's going to choose to be a teacher. But well, let me ask some of the questions that have made it to the chat. 2 or 3 are for Michael. How confident we or you, that what you're measuring is comparable pre and post pandemic. Zoom team meetings can be measured, but when you were chatting someone over the, I don't know, the cooler, it's not as easily measured. Second, is it a good idea to measure productivity of the relation between outputs and inputs in this context, again, because there was a lot of work that was being done at home, taking care of kids. And another one, I had trouble understanding how the number of employees is incorporated in the productivity analysis. Should there be some compensation for if you want layoffs?
Okay, thank you, Laura. Let me answer Sergio first. There were no layoffs. This is an IT services company. So as you might imagine, their business was very good during the pandemic and still has been. You know, we're measuring their productivity falling by something like 10 to 20% as I define productivity here. But their profitability went up. And that suggests another question, which is, you know, how do we measure productivity? To me, as a personal economist, I want to look at how much am I achieving given my inputs? And then a second question is how much is what I'm achieving valuable to my employer? And that's the sort of value marginal product part. You know, are profit margins going up because demand is going up or something like that? And I'm not a macroeconomist, so I'm not quite sure how to resolve that, but I wonder if Federico and Nick could help with that. Let me see Daniela's questions quickly. The point on water cooler conversations is perfectly fair. We don't measure people walking down the hall and knocking on someone's door or something like that. We do have a variety of different measures, though, of communications pre and post. And, you know, we tried as best we can to try to measure the patterns in those. And I think we're fairly confident what we're seeing is real, even though the measurement isn't perfect here. On your question about outputs and inputs, the second one, my answer would be it depends on who's asking, what their purpose is. If you're an employer, you want to know something about, are my people performing more effectively? And if not, what are the causes? And is there something I could do about that? As a macroeconomist, I would care about things like, or a labor economist, I suppose, in public policy, I would be caring about what's the effect of having kids on home, on the family, on women's careers, and so forth. And I would want to think about productivity more broadly, including things like saving commute time. So those are a couple of quick answers for what they're worth.
A question for Federico. Do you know the value of the linkages that were not recovered? It would be interesting to check if the value of the lost linkages was reallocated to other linkages that rather than completely destroyed. This has the potential to boost concentration, although it is also possible that it may increase productivity if we believe there might be some economies of scale.
Yeah, no, great. And just first on your point, Laura, on gender. So that's a huge issue in Chile. The crisis has sort of a female sort of a face, in the sense that sort of women have been having sort of laying the burden of the crisis much more than men. And the bank has been sort of showing this systematically during the sort of the full pandemic, and that's certainly something that is important and we've been showing. In terms of the linkages, there's an interesting pattern there. I didn't have time to show it, but we do see that, you know, if you have a larger relationship, sort of in terms of flow, it's more likely that that link is going to be recovered. So we see the sort of smaller links in terms of magnitude of the transaction are the ones that are less likely to be recovered after they are destroyed. So there's definitely a selection pattern that it's related with the size, at least. And we think that must be also correlated with also the age of the relationship, in terms of sort of like the tenure of the relationship, how long it has existed before it was destroyed. And these are type of patterns that we're looking at these days, and we're sort of looking at more in detail how the selection process happened and how that affects productivity.
Let me see if there are more questions. I actually had perhaps a comment for Nick and Mike. I didn't find your results inconsistent. I actually thought they were complementary. So I don't know if I misunderstood something.
I agree.
Okay, so, and then
I don't know if Nick does, though.
Oh, fair enough.
No, it was great. I mean, it was really interesting. It was more I know my sense is maybe it's a measurement of productivity. You're right that hours go up. But okay, you couldn't stop sharing your screen. Is that all right? Because it's a bit, thanks. It's a bit easy to see everyone's. Yeah, I mean, there's lots of effects of working from home, and I guess it's how to measure all of them in terms of, you're right that the siloing thing is there. So people do reach out less to each other. I think a big question is actually full-time versus hybrid. Because I don't think anyone, the tricky thing is like, what's the impact of hybrid versus full in the office? And there'll be, a huge agenda on this that's going to stretch out. I don't know quite how to do that. So it's not that easy to do it. But yeah, no, I mean, a lot of the stuff you show about siloization makes complete sense. It's harder to connect to people remote and you're working longer hours. I think it's really hard to measure hours, actually. One of the things I always thought, when you're in the office, if you take a phone call from your spouse, you probably count that as working time. Although if you're at home, you go talk to them in the next door room, you probably think of that as not working, but I don't know how to measure that. But yeah, it was great. It was really cool to see it.
May I add one quick thing, Laura? Apologies.
No, yes, please go ahead.
I think one thing we have to be very careful about in this research literature is we're focusing on things we can measure, but intangibles matter a lot in organizations. So culture, development of social networks, development of human capital, innovation, those are things that we really have to try harder to measure. And I worry that those will suffer more from remote work potentially.
Totally agree. In fact, oddly enough, I talked to Eric Yuan, who's the CEO of Zoom, about this, 6 months ago, and even they're on board. I don't think very few firms have planned to keep people fully remote. So yeah, I think almost all execs I talk to, even firms like Automatic. I don't know if you know Matt Mullenweg is like the CEO of Automatic. So, or Upwork, even these firms still are going to have in-person meetings, but they're just going to do it like a week every few months or so. So yeah, I'm totally on board. I don't think fully remote is the way for it. Looks like in the data about 10% of Americans will remain fully remote, and the 40% that have been fully remote during the pandemic are going to go back to hybrid.
There is one thing, what they want to do, and a very different thing we may find out is productive. Whenever you have to coordinate something, it does become complicated when people are working at different times of the day. And I do think people are going to resent this, that they chose to work when they wanted, but many times that's at 11, 2 a.m. And I think that also is going to come back to haunt. There's a question for Mike. If the vast drop in productivity is due to communicating effectively being more difficult, is the persistence of the effects surprising at all? What I mean, are you surprised at all that firms are not getting better at communicating?
Well, we're looking, thank you for that question, Brenda. We're looking at 5 months of the work from home period. So it certainly has persisted, but now in October of 2021, maybe it's better. I think all of us experienced Zoom doom in 2020, but we learned and adapted. When it first started, we were all at home, our calendars were full of a bunch of meetings. And at some point, people realized a lot of these meetings are stupid and we can be a little more efficient about it. So I suspect that this company has learned and improved to some extent, and so will everybody else. We just don't have the data to show that yet.
Let me see if there's some more questions. I have a generational question. So I see the younger people not caring as much, and I see them, as I said, going to the Red Sox game and packing it up and then having a party. And so how much do we think this is going to persist? And I go back to some of the surveys Nick presented, that they don't want to be in an airport, in a train, they don't want to be in an elevator. But then again, I do see them, all of them, going to concerts and Red Sox. So is there a generation thing to it? Doesn't mean it's going to change, it's going to get better, or as they grow older, they will become also more conservative in their exchanges with, I don't know, the rest of the world.
Well, partly I put that survey. The interesting thing on that survey is a third of people are totally relaxed about going back already. So you could easily have the Red Sox game filled out by that third. I think for firms, and I talk to firms, they're in a different position, because take Salesforce Tower, this like big skyscraper in San Francisco. If you're a tenant in there, and I've talked to a few companies that are, you need to have like 95% of your employees are comfortable coming back in and getting in subways and elevators, which is very different from a third. So that's probably why I think these skyscrapers are in big trouble, because that's almost never going to be the case. You only need like 10, 20% of employees to say, I don't ever want to get into a packed elevator again. I mean, you can't use those buildings. So when I've talked to REITs and commercial property companies, they're kind of saying, look, these skyscrapers are not probably ever going to go back to 70% or more of pre-pandemic. I mean, they're just worth less. They're just worth less money. So the one in Boston, the Pru, that is less valuable than it was pre-pandemic, because you can only get 70% efficiency versus pre-pandemic. I mean, it is what it is.
So what about intangibles? Are you also concerned, Nick, Laura, on Michael's take on this? That you know, intangibles are going to be hurt in this new world of hybrid labor agreements going forward, or there's going to be some potential option for substitution, or new technologies are going to allow these intangibles to still be created as they were before, but maybe in a different format?
I mean, I'm totally aligned with Michael. So just to be very clear, hybrid is best. I'm totally aligned with Michael. So you need to be in the office, but you don't need to be 5 days a week. So if you cast your mind back to Otto Levy-Murnane or some of those task-based models of the labor market, think of pre-pandemic, what we spent minute by minute doing. Probably only 50, 60% of the time. Less for academics was actually in large meetings with other people. So hybrid, the idea is, imagine as a faculty member, right? You come in for the seminar and teaching on 2 days a week. All of your meeting with grad students, other researchers, teaching, everything is on those 2 days. They're like exhaustingly social. And then the other 3 days, you just reshuffle to data work, report writing, paper writing, are on those other 3 days. So you're still spending just as many minutes with people, you just reallocate within the week. So that's the way it goes. That's improvement in productivity. The issue is if you go to zero, then you're in trouble. And so this is why hybrid is very, very different from fully remote. It's really not the same thing. In some ways, hybrid is kind of the best of both worlds if it's well organized, which is why almost every firm's going to it, to be clear. Hybrid is like a no-brainer. Like every company I talk to is going to hybrid. I mean, as you mentioned earlier, the Bank of Chile, like everyone is. Even Goldman Sachs and JP Morgan that tried to get people into the office 5 days a week have now given up. So I'm not aware of any, they've quietly backpedaling. So I'm not aware of any large corporates that, you know, have graduates that can work from home that are trying to get them back in 5 days a week, because it's kind of, you know, it's suicidal from, anyway, I stopped because we're about to be out of time, but I think we're aligned that you need to have some face time. Look, academics always did this anyway. Most of us didn't go in 5 days. We probably work from home 1 or 2. So I mean, it's nothing, it's no change for us, I don't think.
Yeah, I guess you can, go ahead.
No, the one thing is that labs, like scientists, are going every day. so those ones, I mean, they do need to. So I guess we need to think which sector we're discussing. Thank God the people from Pfizer and Moderna are going every day to work to check on the rats. But I'm again, Nick is the expert, and Mike, I'm just going through my gut feeling. And not everyone wants to go to work the same days, or rather everyone wants to go, not go Monday and Fridays. And I do think that's going to come back to haunt. I also do think this is going to be worse for women, because they're going to think that this is better, and they're going to realize ex post that they trap themselves in a worse world where they're staying at home every day and doing everything and not trying to get help or making the husband do their chair and so on and so forth. But again, I'm just going for gut feeling more than anything else. And my failed attempts to try to buy a bicycle Thursday, and I found out that now the bicycle shop doesn't open Tuesday, Wednesdays, and Thursdays. So thank you very much. I think our time is up. I think this was a great session. Thank you, Federico, Nick, and Mike. I think we all learned a lot, and we're all rats of this experiment. So we'll see how it progresses. Thank you very much.
Thanks, Laura, for chairing the session, and thanks, Nick and Mike, for participating. This was great. We hope to be able to make it next year on site and you know, make it more amenable.
Gracias.
Yeah, thanks very much to Laura, particularly for chairing, and Federico for organizing.